Starbucks stock, ticker symbol SBUX. This stock is up 6% year to date, which is quite similar to the S&P 500, which is up 6.7%. On the 2nd of February, Starbucks presented quarterly results where they missed on both EPS and revenue. People love Starbucks because of several reasons: emotion, the ability to scale in other countries, the moat they have in the coffee industry chain, and of course, the dividends. Dividend yield is roughly at 2% and they have grown the dividends for 12 years in a row. But does this mean that Starbucks stock is a buy at current prices? Well, in this video I'm going to show you real quickly what Starbucks does: the most recent earnings report, the fundamental analysis, dividends, returns versus the S&P 500, and in the last part I'm giving you my price target to see if they are a buy or not. And I think you definitely want to see that part, so make sure to watch until the end. And I'm also very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So, what does Starbucks do? Starbucks is an American coffee company and coffee house chain. They are the industry leader with more than 36,000 stores in 80 countries. If we check the most recent earnings report, we see that net revenue were up 8% to a record 8.7 billion. Comparable sales were up 5% globally, which is very important to me. Of course, Starbucks can open new stores to increase revenue, but you want them to grow organically with the existing stores as well. The US was up 10%, so that's also looking really good. Starbucks reported an EPS of $0.75, which was impacted quite big by China. Rewards memberships reaches 30.4 million, up 15% year over year, which is very nice to see, of course. If we take a look at the second sheet, we see that comparable sales grew 5%, primarily driven by a 7% increase in average ticket and an offset of 2% decline in comparable transactions. So this is very important to understand. Comparable sales increased because of price movement and not so much more sales. In the US and North America, comparable sales increased 10%, driven by a 9% increase in average ticket and only 1% in comparable transactions. International comparable store sales decreased 13%, driven by a 12% decline in transactions and 1% decline in average ticket. China was the main problem with a comparable sales decrease of 29% because of lockdowns. The company opened 459 new stores, ending the period with more than 36,000 stores globally. 51% of them company operated and 49% licensed. The US and China make up 61% of the total company's portfolio, of which the US is the biggest with almost 16,000, China roughly 6,100 stores. Margin decreased a small amount from 14.6% to 14.4% because of the investment in labor. A few important and interesting company updates to me was the expansion of the partnership with DoorDash, providing new delivery service to Northern California, Texas, Georgia and Florida. In the coming months they will have nationwide availability in all 50 states. Next to that, Starbucks announced to resume its share repurchase program, which is also very nice. They expect to return approximately 20 billion to the shareholders by the end of 2025, with dividends and share buybacks. They also announced a dividend of $0.53 per share, which is in line with the previous dividend. And now that we know more about this company, it's time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue with diving into the fundamentals. Starbucks is a 123 billion market cap company, which makes them the largest coffee chain company in the world. PE ratio is at 37, which could indicate that you pay a premium for this stock. Later in this video I will show you my 3 price targets for Starbucks, so make sure to watch until the end, because PE ratio is only telling a small part of the full story here. Revenue is at 32 billion and in this graph we see that revenue went up in the long run. During the lockdown periods revenue decreased a bit, which makes total sense. After the lockdown periods revenue started to climb to all-time highs again. Margins are going up and down over a longer period of time. Most recently, margins are decreasing a bit, which is of course something to keep your eye on. This is impacted by labor, the increase in materials and all other things. Margins are expected to increase in the coming periods according to the previous earnings release and the forecast. EPS is also going up in the long run, but it's not always steady and consistent. Most recently the EPS went down a bit, but this doesn't concern me a lot because of the short-term issues. Price to sales ratio is at 3.76 right now. It has increased quite a bit most recently and it's pretty high in general, for this type of company of course. This is something that I don't like. Price to free cash flow is around 56 right now, and this indicates that you pay a premium for the stock. The question is Starbucks worth the premium price? Analysis expect EPS to increase at double digits in the coming years, which is very nice. This will add a lot of value to the stock. And it's the same story with the revenue. It's expected to increase at double digits in the coming years, which is very nice. Return on assets is sitting at 14%, which is above my 10% minimum, so this looks pretty good. Return on equity doesn't look good. And the most important number here, return on invested capital, is sitting at 64%, which is an insane number, especially since it's above the 5-year average of 48%. To me, this number is so important for Starbucks. They really know how to invest their money at high returns. Current ratio is at 0.75, which is very nice. It's below the 1.5 mark that I prefer, so this looks also quite good. Total debt is sitting at 23 billion and I prefer companies that can pay down at least a third of the total debt with the total cash position. Right now total cash is sitting at 3.3 billion, so they can't pay down a big chunk of the total debt, which is something that I don't like. So it's very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And in this graph we see that free cash flow is going up and down quite a bit, so definitely keep an eye on this number. Shares outstanding is going down in the long term, which I prefer normally, but you can argue about it for Starbucks, since you pay a premium for the stock, so if the company buys back its own share at a premium price, that could mean that it's maybe not the best investment. However, to me it's very important that shares outstanding are decreasing, since it increases your ownership in the company, increases the EPS, lowers the PE ratio and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyway, dividend yield is sitting at 2%, which is pretty good. Annual payout is at $2.12 and payout ratio is at 68%. I prefer 50% or lower, so right now they have roughly 32% left in cash to buy back shares, pay down debt, open new stores and all other things. The payout ratio has increased quite a bit, because free cash flow is decreasing. The 5-year growth rate is at 13%, which is really good, and they grew the dividends for 12 years in a row, very impressive. Overall, a great looking dividend scorecard, but how about the historical returns? I decided to compare Starbucks stock with the overall market, in this case the S&P 500. Next to that, I added Luckin Coffee and Dutch Bros, which are of course companies that are in a different stage, but do focus on coffee. We're looking at returns including dividends. On the 5-year chart we see that Starbucks had the highest return with 109%, versus the S&P 500 returning 63%. Since Luckin and Dutch Bros weren't publicly traded 5 years ago, it's not fair to compare them in this chart. However, the highest time of being publicly traded return is 47% for Luckin and 5% for Dutch Bros. On the 1-year chart we see that Starbucks has beaten the S&P 500 again with almost 18% versus minus 5% for the S&P 500. Luckin did great with almost 150% return and Dutch Bros had the minus 23% return. On the 6-month chart we see that both Starbucks and Luckin beaten the S&P 500 again, which is very nice. On the 1-month chart we see that the S&P 500 finally beaten Starbucks by a small margin. Luckin Coffee did great with a 27% return. So bottom line, Starbucks did beat the S&P 500 in the long run. But does this mean that Starbucks stock is still a buy at current prices? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 8, 10 and 12%. Since I think they will increase their revenue at higher pace because of revenue was impacted by lockdown in the past couple of years, and even with the latest earnings it was still impacted quite a bit. Next to that, it's also based on the analysis expectations. Profit margin I'm filling in 10, 11.5 and 13%. And for the free cash flow margin I'm filling in the same numbers. It's expected that margins will increase as they stated themselves in the earnings report. For the PE ratio and the price to free cash flow I'm filling in 20, 21.5 and 23, since this is a company that's the market leader and is still growing at high numbers. My desired annual return is 12.5%, since I can get an easy 10% average annual return with owning an ETF. Right now SBUX is at $107. I hit analyze and we only see a few green numbers. We have a low price target of $60, which is quite a big drop. We have a mid price target of roughly $85 and we have a high price target of $117. To me, the high price target is the most justified here, so that means that they are slightly undervalued. My final conclusion is that I really like the business. It's one of my favorite stocks and companies out there. They have a big moat in my opinion and they are the market leader, but also capable of still growing the business at high numbers. However, some fundamentals don't look that great and definitely need to improve in the coming periods. Otherwise, my assumptions might change and that could have a big impact on the price targets, since you already pay a premium for the stock. For now, I'm slowly adding more shares of this stock to my portfolio, since it's already one of the bigger positions in my portfolio. And remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.